Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates. 10-year note yields still creeping higher. Recall not too long ago we were talking about 2% 10-year note yields. Now we're back closer to 2.25, although not there yet. We haven't been able to see a trade above 2.25, which I think would signify probably bringing some more selling, which we haven't seen. This is all about a position squaring, I think, ahead of FOMC, which we get this week. That's kind of the highlight of the week. So yields continue higher. We haven't really seen any substantial data that would have pushed us up here, nor have we gotten any messages from the Fed other than what we heard prior to the Fed wanting to raise rates, wanting to do something with their balance sheet, but haven't really heard a plan. So right now it's kind of a pre-FOMC, let's see what happens kind of trade. And what has it done to volatility? Well, volatility remains low. And if you look at some of the further out months that we watch in December, they're very low, historically low for this time and with this time to expiry, along with the fact that we have this momentous event, this market changing event. Recall when we got into the quantitative easing, when we talked about the Fed buying up coupons, there was really no exit strategy put in place. It was kind of one of those, we'll deal with it when we get there. Well, here we are, still in a cloud of uncertainty, and the market doesn't seem there's a whole lot of fear priced in. It's more about greed, I think, at this point, or neither. But we are not seeing any angst in the market, and volatility still running very low. So what does that take us to FOMC? Well, FOMC is going to be about the message to the market and a plan. How will the Fed go about withdrawing its balance sheet, which went from just under $1 trillion to $4.5 trillion? I mean, what are we going to do with those coupons? Just let them roll off, expire, not reinvest what we have been reinvesting over the last 7 years? I think right now that's going to add some supply to the market, which obviously will put pressure on yields. However, it's the speed and the quantity of how they do that, and that's going to be more about the details. And I don't think anyone really knows how the Fed's going to do it, themselves included, for a sustainable period. So I think the knee-jerk reaction should be yields going higher, which we've seen. However, on a historical basis, yields are still very low, and I think that demand for quality yield is still very high. And at this point, despite the fact that we could see a big spillover off the balance sheet, hasn't really negatively affected the markets. Now, the one thing that you have to keep your eye on is that the other extenuating markets. What will this do to the stock market, which has rallied throughout the entire quantitative easing process and thus? So I think that right now the Fed wants to see what kind of reaction we get from the equity markets, perhaps what kind of reaction will we get from the currency markets, likewise from the commodity markets, because they don't want to fix one fix one wound only to create several others, sort of the waterbed effect. And I think that right now they're going to kind of ease their way in to this balance sheet withdrawal with the idea that they still will raise rates later on this year. However, the forward guidance will tell us the when and the if of that. So right now it's all about the balance sheet. It's all about preparing for that moment with the Fed. However, volatility running very low should be a concern. This has been Todd Colvin coming to you from the floor of the CME Group.